G'day expats. Today we're going to be talking about this week's federal budget announcement that came out on Tuesday night. Now, this budget has been referred to as a super budget, but unfortunately that's not because of the handouts and the incentives being offered. The government has unashamedly targeted superannuation as a means to try and curtail some of the tax benefits, and there have been some other minor changes too that we'll run through in today's video. Nothing was too outlandish in this week's budget, and I think that's probably be expected given that we're probably going to an early election in July. Malcolm Turnbull and Scott Morrison didn't want to rock the boat too much, and we view this year's budget as one that's targeted at middle Australia. A couple of the key points we had to cover off in today's video are personal tax issues, as well as obviously the superannuation changes, which are quite large and varied. Effective on the 1st of July 2016, the 32.5% tax bracket will be lifted up to $87,000 from its previous level of $80,000. Now, this is designed to encourage middle income earners to increase their disposable income. A lot of people have been penalised by what they call bracket creep, and what happens here is when you get pay raises over time, you should be actually getting an increase in your take-home income. However, when you pop over into that next tax bracket, what actually happens is sometimes you can actually be taking home less income. So this is a very effective measure in trying to avoid that happening. The government's also announced that they're going to be still pausing the indexation of the Medicare levy and also the private health insurance through to 2021. So that's good news for the time being, but it's something we're going to watch closely. Some of the largest changes announced in the budget were in relation to superannuation. The first one is the lifetime cap of non-concessional contributions into super. Now, the way this works is that you are allowed to make after-tax contributions into super. Previously, that limit was at $180,000 per year, or you could do $540,000 as 3 years contributions, but then you couldn't do anything for the next 2. Now the government has changed the rules, and you can only contribute up to $500,000 for the lifetime of your super account. This is going to come effective as of 7:30 p.m. on 3rd of May. What's going to happen from here is that from the 1st of July 2007, the government's going to calculate what level of contributions you've made inside as a non-concessional contribution. If you've exceeded the $500,000 cap already, then there's no penalty. But from budget night, which is the 3rd of May, 7:30 p.m. onwards, you cannot contribute any more money into your super by way of a non-concessional contribution. The lifetime contribution cap will be indexed on the average weekly ordinary time earnings, and what that's going to do is ensure that that $500,000 will increase over time, but unfortunately for some, may not be large enough. This change will affect both residents and non-residents for tax purposes as well, so it's very worthwhile getting some advice and determining whether you've breached this cap and what your plan is going forward. The next change was the reduction in the threshold for the 15% contribution tax. Now, previously, if you earned over $300,000, you were required to pay 15% tax on any contributions that were made into super. Now, the government's actually decreasing this, and it's going to come down to $250,000, and the effective date for this will be on the 1st of July 2017. This will affect Australian residents, as well as those who are offshore but who are deemed to be resident for tax purposes. The next big announcement was the $1.6 million cap on pension accounts. Now, what this means is that you may accumulate whatever amount you want inside a accumulation superannuation account, but when it comes time to move those funds across into a pension account and start an allocated pension stream, the most you can move across is $1.6 million. Now, those funds will not pay tax by way of capital gains tax or income tax. So let's say, for example, we've got a $2 million super fund, 1.6 will be moved across, and then 400,000 will need to stay inside the accumulation account where it will be taxed at the normal 15% rate. For those who have already started an allocated pension and do have balances greater than 1.6 million, then by the 1st of July 2017, you're going to need to move those balances across back into an accumulation phase account. These changes will certainly affect both residents and non-residents, and those getting very close to preparing for retirement who have a strategy that may need to be revised. This $1.6 million cap will be indexed in $100,000 increments and will be revised based on the Consumer Price Inflation Index. Those clients with transition to retirement strategies will definitely need to review the latest changes that were announced on Tuesday night. Starting from the 1st of July 2017, income streams inside super that were generally tax-free and were being used to fund TTRs are no longer valid, and the whole strategy has to be revisited. So for those out there who do have TTRs, you'll need to speak to your advisor and get that looked at urgently. And the last big announcement was the removal of the work test. Now, the work test applied to those over the age of 65 who wanted to make non-concessional contributions to their super account. Previously, they had to meet a work test where that was a 40 hours of work in any 30-day period. Now, going forward, after the 1st of July 2017, those over the age of 65 do not have to meet that work test, which is great news for those who want to keep working, contributing to their super account. But obviously, bear in mind, you don't want to breach the $500,000 contribution cap, and also too, if your super account is getting up there, you may need to revisit the $1.6 million cap as well too. For those who are deemed Australian resident for tax purposes, there's also a reduction in the concessional contributions from $30,000 down to $25,000 as of the 1st of July 2017. Previously, it was ranging between $30,000 and $35,000, but now it's a flat across the board. Everyone's got up to $25,000 allowance to contribute towards their super. Now, the good news about this is if you don't actually use up all your $25,000, you can carry it forward for the next 5 years, which is great news for those who are working in part-time capacity or in a contract capacity where your income flow or income stream is wide and varied. So if you don't maximise the contribution cap, you can actually bring it forward and use it in the following tax years. Feel free to leave your comments in the fields below. Also too, feel free to email us at info@atlaswealth.com.au. You can also tweet us at #AskAtlasWealth. Take care and have a great day.